This is in your best interest. I'm Philipp Müller. Today, I'm joined by Freddy Lim. He's a co-founder and CIO of StashAway. We discuss the importance of investing in our daily life, why relying on just saving money may not be sufficient to achieve financial freedom, and the steps you can take to prepare yourself for a successful investing journey. I hope you enjoy it, and if you do, be sure to subscribe and consider leaving us a review and sharing it with your friends. Welcome to another episode of In Your Best Interest. Every 2 weeks, we bring you new topics covering personal finance, investing, and entrepreneurship. I'm your host, Philipp Müller, and today we will be chatting about a topic that has been requested by a lot of our listeners, and we're grateful for your feedback. It's about the importance of investing in our daily life. So everyone knows that saving on a regular basis is important, and being located now for the last 3 years in Singapore and 2 years before that in India, the savings rate in this part of the world really surprised me. It tends to be very high compared to countries like the US, where I used to live before. So the act of saving money actually is less of a problem here, which is a great place to start from, right? A great place to be in. However, what is striking to me is that people tend to not necessarily invest their savings. Instead, they keep them in very, low interest checking accounts or, savings accounts and things like that. So the problem there is that inflation, and a topic I want to discuss today as well, really slowly starts eating into your savings, right? And it's a very a dangerous enemy that every one of us has. So today, I actually invited a guest that has been on our show before, and he's a real expert when it comes to investing. So I'm glad to have him back. His name is Freddy Lim, and most of you know him as the CIO and co-founder of StashAway. Hey, Freddy, it's nice to have you back on the show.
Hey, Philip. Thanks for inviting me back, and you've been very kind to ask me to saying that I'm an investment expert. Thank you very
I
much.
think you are. I think you are, and I think a lot of the listeners would agree. So when I speak to people, they always mention your name. So for listeners who would like to learn more about Freddy's background, I encourage you all to check out the first episode of the In Your Best Interest podcast, where he shared with us his upbringing, first job. Also, he shared with us the best investment he's ever made. So if you want to learn more about that, about Freddy's background, I encourage you to check out episode 1. We'll also be linking those in the show notes of this episode. But Freddy, let's get right into the topic then, right, of today's show. So the importance of investing in our daily lives. I already touched a bit on, saving versus investing, but how about we dive a little bit deeper on that? What is your opinion on saving versus investment, and where do you draw the line, right? Like, in which buckets do you put saving versus investing, and the importance of either of them?
Well, I think they cannot be separated in the sense that you gotta first have savings, and then you're able to invest those savings. Because otherwise, doing investing in any other way other than savings, that means you have borrowed money or you find other channels that invested money that doesn't belong to you, right?
Yeah.
And so it really starts with saving first. But I would say this: just savings is not enough, because it's like you're climbing a hill and you're just climbing it. You could have used a bicycle to cycle upward faster, right? And you get a lot more help with in the forms of return along the way over time that help you save and make some return on it that gets you to your life goals faster, right? So that they do come together.
No, that's a great point. If I drill a little bit more, you said, savings alone is not enough. I wholeheartedly agree with that, and I want to get more into, the investing, why it's important. But from a saving standpoint, do you have a guideline that you use yourself when you first started out working, to say how much to save? Like, is there like a percentage that you always aimed for when you were younger, or still do?
It really depends on the stage you are in. But I remember when I first came to the workforce, I do have a certain targets. I was aiming to save 25% of my monthly income after taxes. To So I budgeted for taxes, right? You don't get taxed yet. You sort of save extra, knowing that you're going to get taxed later, right? But what I'm saying is the excess above that. I was targeting to save 25% a month as a young man. Um, but I never thought about investing those savings back in those days. It's not like it's easy, right? Online brokerage accounts were still very new
Yeah,
back in year 2000. Today, there's a lot you can do, right? And so, yes, 25% was my target. It was random, not really based on my actual lifestyle. But that can change over time, right? As in your life, you may get married, you may have certain changes in your lifestyle and needs, or certain family members to support. But the essential idea is to have your income, right? You spend part of the income, don't spend more than your income, and you just try your best to squeeze in some savings, right?
yeah.
So that was the basic idea, and it's very traditional. You're just trying to use savings and time to get there.
Yeah, no, agreed on that, and I think 25 is a great number to start with. I always aim to have at least I'm trying to get closer to 35, but again, as you said, it's also very dependent on your life situation, right? And in some years you might be able to save more. You got a promotion. In some years, you have a child being born, right? That will have an impact on your cash flow on a short-term basis as well. So appreciate you sharing a little bit about your own experience there as well. So you said alone is not enough. Let's talk about that a little bit more. um, we kind of established, here, especially in the Asian space, people tend to save quite a lot, right? But it's stuck in low interest bearing accounts. I don't know how many different financial plans I've done now here, and I always see people with quite the large amount of cash sitting in checking and savings accounts, right? Earning literally 0.0 something percent. And it's after they did all the hard work of working, the hard work of saving, and then not able to deploy that money into more investments. What are some of the enemies that people face when they just keep their money in cash?
Yes, keeping it in cash in the bank certainly feels safe. And also, why not? That's deposit insurance, right? Up to a certain amount. And however, the problem is we are then neglecting the fact that things get more expensive over time. Inflation is the ultimate enemy for someone who just purely saves. And the better the economy does, at times, the higher the inflation goes, and that really erode the person who just hold cash. So I would say the greatest enemy is inflation.
And inflation, for people or listeners who've not had, don't know too much about inflation, can you go a little bit deeper there to just explain people what inflation is? Because it's, to me, it's also, when I first explain it to people, it's always it's like the invisible enemy almost, right? Because you can't really see it, you don't feel it on a day-to-day
Yes.
basis.
Well, you may not be aware of it because 10 years ago, you weren't here at this very place buying a chicken rice in Singapore. But you know that the price back then and today is very different. Suppose it's $3 before, is $5 now, let's say, right? And and that inflation creeps very slowly and is invisible until it became noticeable. Then it's too late. Because then you realize, oh, now it's $5, but this is 10 years later now. Realizing it now is late, right?
Yeah.
So inflation is invisible in many forms as well. You can see that, and I'm not talking about the government measure of CPI and all this consumer baskets. I'm actually talking about inflation outside consumption, right? I mean, you buying a property and it could get more expensive with time, or the asset prices going up is itself a problem, right? Because it means that your money over time is unable to buy as many units of the underlying assets, whether it's a property or a stocks or a good company that's been growing for 10 years, right? So inflation, people tend to think about it as consumer price inflation, what you consume, and they think about that. But actually, that is very, very low measure. It's sort of biased downward. We know that in reality, there's a lot of invisible inflation going on elsewhere that makes things really expensive for you in many, many mysterious ways, right? You may be saving up for buying putting down payment for an apartment, but in 3 years' time, the apartment is going up 20%. Then what happens, right? So we do need some growth assets as well, just to stay online with other forms of inflation. And of course, imported inflation is another one. Being in Singapore, we are a small open economy, and we do import food and agricultural products and raw materials from other places, right? So there could be a lot of sources for how we can incur inflation, why things would dilute our purchasing power if we don't do something about it.
Yeah, I think it's again, and I thank you for this explanation, Freddie, because I think the it's a very difficult concept to grasp. I know it's always in the news, right? But again, on a day-to-day basis, you don't notice. But I think always a good one for our listeners to try out. Talk to your grandparents or your parents, and they will always have. At least when I talked to my dad, he said, "Oh, we used to get this hamburger for 50 cents, and now it's $2.50, right, or something like this." They will,
Hmm.
if you talk to some older people, I think it always gives you a very good uh, incline on what inflation actually does. And for the people who are, going to college now or have recently gone to college, college tuition is, compared to some of the other inflation measures, has been skyrocketing, right, over the last 30, 40 years.
I think college education is a great example
Yeah.
in the sense that you may be in Singapore and you want to study somewhere in the US, and you find that the inflation is not from Singapore anymore, it's actually in US education, has gone up a lot. And if the US dollar goes up further, that makes it even worse for you to afford it. So
Yeah.
in a way, the only way you can handle that risk is to, be able to think about investing and globally, right?
Yes, absolutely. And now if we may move away from inflation, let's look at the counterpart of inflation. And I do want to. The topic is investing, right? And with investing, you're trying to, one of the things you're trying to achieve is beat inflation, right, Freddie? So on the opposite side of the coin, it's something called compound interest, right? And there's a, it's called what did Albert Einstein call it? The eighth wonder of the world, I think, right? So um, can you maybe explain a little bit about, now what is compound interest? What does it mean to the people, and how can they use that to their advantage?
Right. My favorite quote of my favorite person ever is that the Einstein, the physicist, not as an investor, say that the power of compounding is the eighth wonder in the world. He's obviously referring to the expanding universe because it does expand at a certain rate per unit of time, and given more and more time, the universe is getting further and further apart, right? So,
Yeah.
so we this is very scientific, but I personally believe that it applies the same in investing because if you are just focused on investing your savings, you stick it there, you don't try to time the market, you just stay with your plans. I tend to see feedbacks from people who's done that, right? There are people who's older than us and they spend 3 decades building up their portfolios. They basically compound. Just with time, the diversified portfolio grows with the economies. Mind you, I'm talking about a diversified portfolio that's very broad based, right? And it grows along with global trends, global growth. And with time, they compound, right? Now, the same can be said for fees, right? If you sort of, no, sorry, for fees or inflation, they are the same, right? You invest in a high fee product or you don't invest, you get eroded by inflation. Every year, if inflation is 2%, you get eroded 2% a year. If you
Even though
do
you
the
think your money
compounding,
is safe in a savings account, right? That's the other thing.
that's right. The erosion also compound with time, right? Because
Yep.
every year you're losing purchasing power a couple of percentage point, and then you're going to keep losing that, right? And I'm just doing a back of the envelope math here. Oh, if it's a 2% inflation a year over 30 years, you will be eroded by a whooping 45 percentage point per dollar. Let me try to get this right. 1.02 to the to the
Yeah.
power of 30, right? And then invert that. A dollar is only worth 55 cents in 30 years at a 2% inflation rate, which is not a lot, do you think?
No, and I think countries are aiming for right about that 2.5%, right?
Yes. Yes. And so I would say compound interest. Actually, the second line of the quote from Einstein is that he who understands compound interest earns it, he who does not pays it. So in this case, the saver pays it through inflation eroding your dollars, and the investor gains it through growth over time, right?
Yeah. No, I think it's a great quote. I like to use it in some of my seminars as well because it really, really hits home, right? If it's, you can make the argument for inflation, you can also make the argument against, high interest debt, right? Works the
Yes.
same way. But because you want to put yourself in a position where you start earning income, right? And that's where I wanted to go to actually next is you cannot earn income forever, right? So at some point you're getting older, you want, you worked for, 30, 40 years of your life. You have paid some into pensions. In some countries where our listeners are, they might not have pensions available or at least not, defined benefit plans, right? So these people need to save, right? They need to put money away. And one way to do that is starting to invest, right? And this is where compound interest comes in again, right? Because you cannot work forever. At some point, you're getting older. You can't do the job that you used to anymore, or you want to enjoy life a little bit more. How can investing here help you, Freddie?
Well, look, it is true, and I personally have been through that phase. As you grow older and more senior in your industry or position, there's an old saying that if you are not up, you're out.
Mm,
There's no such thing as I love my work. I want to be in this position, this exact position forever. If you're not up, you're out. And the requirement for a senior person all the time gets bigger. Your leadership, growing the business, making new initiatives. So it is difficult. What I'm trying to say is it is difficult to stay in your position. It gets harder and harder over time, and you may not be hireable, right? Even if you are very competent, just by the fact that you are more expensive and as you are the more expensive part of the workforce, it makes it hard for you to be hireable in the labor market, right?
yeah,
Options are going to be more narrow. So you definitely need to have diversified sources of income,
yeah,
and there's many ways of doing it. And in the past, people do it by directly investing in properties. They use the savings to pay for the mortgage. That's a form of investment. But today, the property cycle has really changed, right? It's not as high yielding as before in terms of rental yield. It does cost money to just buy property, right? Stamp duties and
There you have
taxes
it.
and
You
what
still have a
have
down
you.
payment, right? Yeah,
Yeah, down payment. It's not an easy endeavor, but today we're very fortunate to be in a world where, in the case of property, you don't have $1 million, you can still spend $500 and buy a unit in a REITs ETF or even a REITs. It's very democratized now on the stock exchange. Even in Singapore, there's ample of a very solid REIT provider with a strong long-term track record, right? So there's no excuse not to invest. You can own a fraction of ownership of a real estate investment trust where you gain exposure to, say, property, and it saves you the pain of down payment and stamp duties and getting a bank loan, right? So it's very democratic. It's super exciting. And this is as an example, right?
Yeah,
And it gets better now where I mean, that's why StashAway exists. We are one of those who try to bring you the word global diversified investing, right, on our platform, up to 38 asset classes with up to 40 plus thousand securities, right, that investors can curate from their portfolios. And that means that at a fraction of the cost before, it's just with a click of a button, people now can just invest any amount. It's super exciting that people know that it's possible to gain financial independence by doing something about it, right?
absolutely.
I think investing has been made much easier than before, much more diversified, much more sophisticated, much lower fees. There's
Yeah,
just no excuse not
the
to do
barrier
it.
of entry is just so much lower, right? And I think I wanted to get to that point actually very shortly. But you mentioned one interesting fact, and that is you want people to have diversified income streams, right? Because I think in today's world, and I see it, with my friends and family members, etc. The life cycle of people staying with one company is significantly reduced from 20 years ago, right? I remember still, yeah, the more, my dad's age, like people in their early 60s in Germany, most of them spent their entire career at one of the big, large German conglomerates, right? And never
Yes,
no, but never left, right? They're very good jobs. They used to have pensions at those companies. But nowadays, the life cycle of companies also, going in and out of the S&P 500 even, right, is significantly shorter. So companies, you're getting disrupted more often, or whole industries even, right? So having a diversified passive income stream outside of your day-to-day job, I feel, is becoming so much more important. And you mentioned already that real estate can be one of them, right? You might have your rental properties, or it's easier to get into things such as REITs, or diversified portfolios. And I think some of the other ones, and maybe you have some more, is too. It's like, hey, a lot of people nowadays, they have the energy, and through the use of the internet, a lot of people are setting up side hustles, so to speak, right?
true.
um, to diversify. And I think that that's a very, very good start if you want to start creating, which is also an investment in itself, right? You're investing in your
Yes,
future, by creating these different streams to get to a point where you become more financially free, right?
yes. And the act of investing is everywhere, whether you are aware of not, right? Whether you're buying a property, a second home, right, or whether you are doing a side business, it's all an act of investing. But what I'm saying is that you don't have to today be the one to open a side coffee shop while having a day job, or that. I mean, it's actually not an easy thing to run a business. But today, it's very democratized that anyone now with any amount can have a super diversified portfolio that's very global, that's multi-asset, right? I think that's one of the big thing today. You can invest to maximize gains, and there's no minimum barriers.
Yes. And you did make a good point that I wanted to actually get back to before, is that a lot of people, when I speak to them at our and some of the seminars, or just friends and family, um, they tend to say that they are overwhelmed by investing. So again, yourself, myself, right? We've been dealing with investments for quite a few years now, right? And we're interested in it on top of that, right? And it's part of our job. But the research, the sheer amount of choices available in the markets, and not wanting to make mistakes with their savings, right? On top of working their daily job. So, what are some of the guidelines you can pass on to them? Because I feel this is exactly the disconnect, right? Between people, they save, but they don't find the time, they don't have the resources, they don't trust the sales guy, and that's why they don't invest at all, which is a bigger mistake, right? As we know, and hopefully our listeners have gathered today.
Mm-hmm. Well, I would step back and if I think about step one, it would be to go back to the a piece of blank paper and sit down with your other half or get a friend or get a financial advisor, whoever that is, right? And sit down and look at your income and your expenditure and how much savings you have. And then start planning, right? The first step of that is like, do you have sufficient amount of cash to as a rainy day fund, right? In case anything happens or you for some reason you're not working anymore, you have some buffer. I think that is number one. Anything above that buffer that you have planned for is then becomes your investable savings. That's the part that you can start thinking about investment. And this is a very important part because the last thing you want is to invest the money that you actually need, and then the day-to-day movement in the market, right? It so happens today, market is not doing very well, and you need your money, and you're selling on the low, hence hurting yourself, right?
Hmm.
The power of compounding takes time. It relies on the averages, and to realize that you need to stay invested. So only invest the money that you can invest. So first have, I don't know, I would suggest 12 months of living expenses in cash, right?
That's
Start building
what we
towards
have as
that.
well. Yeah.
Yeah. And then anything else is easier to talk to because you free yourself from this nervousness, right? You already have a 1 year buffer, and you when you invested those amount above it, you are less likely to be very overreactive to near term events, right? So that would
Yeah,
be
and
the first thing.
no, for sure. And then let's say it's, our users have done that. They're now overwhelmed by the choice of investments, right? And yes, I think for Singapore, you already made a good point, right? Like, there's people like us at StashAway who can help you weed through a lot of this and a lot of these problems. But for people that are listening that are not necessarily from Singapore, what do you suggest should be their first steps when they look at investments in general? Like, should they go and right now, in 2020, Tesla is the hot new thing that's being pushed, right? Or where is that something they should invest in, or do you see where should they start? Let's say they live in a different country where Stashway, for
I
example, is not
I
existing.
Actually, the answer is not about what is out there that you should invest in. It's not about what is the hottest thing to invest in, but it's about first, what is your risk level that is suitable for you? And you don't even know what you're going to invest in yet. But before you invest, this is the first question: what is the risk level for me? And the way we think about it, and the industry thinks about it, is that in an extreme event, if you lose X percent, right, in any given year, if you're fine with it, that's your risk level.
Mm.
So, for example, in an extreme event, something happened like this year during COVID-19, right? Let's say you lose 20% of your on your portfolio. Is that a number that would irk you so much that you would overreact? Meditate on that, right? I mean, have a good think about it. And if you're okay with 20%, then that is the risk level you're comfortable with. But if you're more conservative and 6.5% is more reasonable for you, right? Then you belong to a lower risk profile. Then there are people who just invest 100% of their net worth in Bitcoin, and they belong to the category of 80%, right? In the extremity, their risk is really 80%, and they're okay with it. So everybody has a different number, but you got to pin down that number for yourself. What is that risk level first before you invest?
No, great advice, I think, because most people look at return first, right? They said, "Hey, I want to get 20% a year," and then pick the investments from there, and then looking backwards, right, at what has done well, and what has not done well. Um, no, I think this is great, Freddie. To Before we wrap it up, and I truly am thankful that you came on and explained a lot of these concepts and why it's important. Um, are there any, I don't know, podcasts or books that you may have that our listeners would be like have something to learn from in this kind of topic that we talked about today?
Yes, there's a couple of pretty good books. Some belong to the classics, so let me try to remember it. I think the book Money by Anthony Robbins.
Yes, I was going to
It's a
mention that.
Yes, it's a very
Yeah.
good one, but it's a big book. So you can select the chapters, then you can take it in stages. But the easier one to digest is the one that predates this one, I think, by Robert Kiyosaki,
Yep.
Rich Dad Poor Dad. If you want to go even more ancient times, the richest man in Babylon is they're all similar concepts. It's just different way of describing the same principles. Um, these three books would be the same, and you can just pick one for financial planning. I think planning is half the battle before you invest.
Yep, absolutely agree. And I think all three books, I've read all three of them. I read them all while just getting out of college, starting to save, and they've been godsend. So any listener, I suggest you pick one of the three up. I agree with Freddie. They're great books. They're written in very plain English, very easy to understand, and they really also, underscore all the points we've made today. So again, Freddie, thank you very much for being on the show again. We always appreciate you here. I can
Thank
tell
you.
that from myself and the listeners. And of course, I'm sure we'll have you on again in the future. Otherwise, Freddie, have a great day, okay?
Well, thanks. I look forward to our next conversation. Good
Thank
day.
you.
That's it for the show this week. Thanks for listening. If you like what you heard, subscribe and leave us a review. The reviews really help us, and we love reading your comments as well. In Your Best Interest is hosted by me, Philipp Müller. We're produced by StashAway, and we're mixed by Mo Ramley. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.